Hi everyone, thanks for taking the time to join today's webinar. I'm Ethan, Education Lead here at IG Singapore, and I'm delighted to be able to host today's session. So anyway, firstly, thanks for being on time. I understand it's dinner time right now, so if you are having your dinner, please feel free to continue as you tune into today's session. Before we kickstart with the webinar proper, right, I'll firstly just do a very quick mic check. So if you're able to hear me, there is actually this control panel with a question section. Please type in a yes in the question box in the control panel, so I know that there isn't any issue with the audio. Okay, thank you for the response. I see a few yeses coming in. So it seems like the audio is working fine. So if you're not able to hear, then likely you need to change the audio output in the GoToWebinar settings. All right, so before I introduce our first speaker, I just wanted to open with a very quick thought. So I think that many of us can tell that the market is kind of having a split view of the US economy. Given the 2 straight quarters of decline, it is now kind of in like a technical recession, but some of us may also disagree and point that there is a robust and healthy job market. So as the recessionary fears mount, right, we also notice that the US indices rallied. So it's kind of a bit of a mixed view. And today I'm happy to have invited 2 speakers who will be sharing with us their views on the market. Okay, so our first presenter today will be Jun Rong, and he will be sharing on the topic of tackling market volatility in uncharted waters. So Jun Rong is a market strategist here in the IG Singapore office. He regularly provides analysis and commentary on financial markets for various media channels and conducts webinar on market outlook. So if you have seen him on TV, because he's also appearing in Channel News Asia and also on Bloomberg TV. And prior to joining IG, right, Jun Rong also took on the role as a US research analyst in his previous stint. So without further ado, I will pass the time right now to Jun Rong to share on his presentation. Jun Rong, please.
Okay, thank you so much, Ethan. And I guess everyone can see me. Okay, so I'll just start off the presentation. And of course, thank you for joining me here for today's webinar. If you look at current market conditions, I would definitely say that it's kind of hard to maneuver, right? I mean, we have been seeing strong arguments from both the bulls and the bears, and it seems to make perfect sense on both sides. So how do we actually tackle it? If you look at past market bottoms back in 2008 and 2009, they are somewhat marked by economic data kind of showing a lesser extent of a decline. So that kind of leads to an improvement in risk sentiments that the worst is over, and there we have it, we have the market bottom. But this time around, we have seen the prime where, the S&P 500 surged close to more than 10% over the past month, even though there's some slight retracement. But, we haven't seen the worst in terms of economic data. So no one could really pinpoint that the worst is actually over for economic growth conditions. So is this really the market bottom, and, what does it entail? So with that, for my segment today, I will be sharing with you some of my market views, some of the key levels that I'm looking at in terms of the US dollar, in terms of the 10-year treasury yields, and also some of the asset classes that could, carry some form of implications ahead. Okay, so some disclaimer to start things off. Do take note that the presentation today is, of course, for educational purposes only. It's just for sharing. It does not in any way constitute any investment advice. So please do perform your own due diligence in your trading journey. Okay, this is me. I believe that Ethan has given a very good introduction about who I am, but just 2 things to actually take note here. One is, of course, the Twitter account. So if you have a Twitter account, do follow me at Yeap_IG. So as and when I'll post some market developments frequently on the Twitter account. For those who do not have a Twitter account, I mean, fret not. We also have a Telegram group chat. So you can search IG Asia. That's the group name. So IG Asia, you can actually access a whole list of content on a daily basis, all collated from our team of analysts globally. So 2 points, Twitter account and also the Telegram group. Okay, so the header for today's session is whether inflation has peaked. And of course, at current point in time, I believe that many of you have seen the downside surprise in the inflation reading last month. And, especially having seen that downside surprise, I think 90% of you could agree with me and take the stand that inflation has already seen its peak, at least for the US side. So the focus next will instead be the extent at which it actually falls towards the Fed's target of 2%, because this is their eventual target. So this is the projection that is obtained from Reuters. So third quarter 2022, we may have seen the peak of inflation at 8.5%. But what comes next? So if we look towards the fourth quarter of 2022, we are looking at an inflation reading of 7.5%. Still elevated, I would say. Moving into next year, first quarter 2023, some improvement right there towards 5.7%. And thereafter towards the second quarter 2023, close to 2%, but still stands at around 3.8%. So this is definitely on the pretext of another 125 basis point increase that is being priced from the Fed to undergo a further rate hike towards the rest of this year. So overall, why I believe that there are some market expectations that the Fed could potentially have a dovish pivot on the peak inflation narrative. Looking at these inflation projections, I will believe that the Fed may want to avoid having too much of a premature dovish guidance in its policy approach, at least in the near term, until we are able to see somewhat of a clearer shift in terms of the inflation risk, whereby we are seeing it trending much lower. And I would think that could come in terms of first quarter 2023, where inflation is around 5.7%. We have seen a sharp decline, an ongoing decline from the peak of 8.5%. And thereafter, in first quarter 2023, that could be where we could see a greater indications of the dovish pivot coming from the Fed itself. So near-term wise, things are still very rocky. I believe that they may kind of take on the more cautious approach. I mean, markets have been blaming them for being behind the curve. So now I believe that they could still be somewhat more cautious in kind of a signaling somewhat of a policy shift. So that could last until fourth quarter 2022, where inflation are still around the 7-8% level. But moving into next year, if things continue to improve based on this projection, that could be where the Fed could signal a dovish pivot, and that could be a very strong tailwind for a risk sentiment. Okay, so this is what markets are pricing based on the Fed funds future and also the Fed funds rate. This is based on the dot plot in the June FOMC meeting. So you can see that markets are still somewhat more dovish than what Fed members are actually pricing at. So of course, we will have the next dot plot diagram in the September meeting. So that will really be a very key focus point, because that is where market expectations could adjust accordingly or could be more aligned towards the Fed's policy vote. So near term, some pushback against the dovish pivot could be expected, and that is a catalyst for a volatility. We have already seen some of that playing out over the past few days, and especially heading into September with the next FOMC meeting. Definitely the next dot plot will be of a key focus here. But as of now, market pricing, I would say, are still slightly more dovish than what the Fed members are kind of looking at. Okay, and after being criticized for falling behind the curve, that could be drive Fed to be more wary in switching its stance. So there may be some near-term disappointment for our market participants who are expecting to see a very quick indications of a policy change. But I believe that may not happen at least in the near term, or at least there are really greater indications that inflation risk is kind of brought to its lowest point. As of now, inflation risks are still there, and that could mean that the Fed members could remain firm on its fight against inflation. So near term is seasonality is of any use. We are heading into a period which has traditionally been met with volatility. If you look at the average performance for the VIX over the past 20 years, it suggests that the VIX are relatively more active during the period of August to October, before things start to improve towards the end of the year. So if you look at the movement of the VIX, if you look at the daily chart, when markets was kind of at oversold technical conditions, at oversold market breadth just a week ago, the VIX was kind of hanging around the level of 20. There was some consolidation at the 20 mark. And that is a very key point because, anything below 20 tends to be deemed as a favorable risk environment, whereas any shift above 20, that could point towards an increased risk in the market. So past few days with the sell-off, we have seen that after the consolidation around the 20 mark, there was kind of a near-term rebound in the VIX. So that causes some of the, that kind of move in line with the sell-off in the US equity markets. So August, October, things may tend to be slightly more volatile. So, after having seen that surge in the S&P 500, we are seeing some moderation from oversold technical conditions, which are kind of warranted for. But with this retracement, it will be key because, having such 12% is very hard to pinpoint several key support levels because markets really go out so fast, right? So even though we have seen some, some battle within the bull and the bear during this 12% surge, I would say it's not a very strong point. I mean, because it just lasted for a little while and then, things starts to continue on this upside again. So with this retracement, I believe this is really a good opportunity for markets to really figure out, to retest some of those key support levels and to see whether we are able to actually form a higher low ahead. Because if we are able to, that could point to a further reiteration of the upward bias that we have seen since the middle of June itself. So personally, I believe that it's definitely warranted for markets need to retrace to retest some of those key levels. And I believe the next 1 or 2 months with this high volatile market, that will actually provide a very good opportunity for the US markets to do so. And of course, looking ahead, we are looking towards the Jackson Hole Symposium. And also in September, that will be the FOMC meeting where the debate continues to be about whether we will see a 75 basis point or whether we will see a 50 basis point. So next 1 or 2 months, I believe downside risk is there, but towards the end of the year, things could turn for the better, as seen from the seasonality itself. And if you look at the Fed funds futures market pricing, this is actually what markets are pricing for the path of a rate hike ahead. I would say still relatively split between 50 or 75 basis point. Just 1 week ago, markets are leaning towards a 50 basis point. And then just a few days later, at this current point in time, markets are slightly leaning towards a 75 basis point hike. So I would say the debate is definitely on. And while I believe a 75 basis point hike could actually be deemed as, a hawkish move by markets, there could be some downside action in equities. I think post-September, if we were to see a 75 basis point, I think it will be good. My rationale is that, the faster we get to the end of these overall rate hikes, I believe the markets can quickly, can price that in sooner. And that is where, once that is priced in, we will be looking towards the next rate cut. Why? Because historically, the period difference between the last rate hike and the first rate cut doesn't last very long. So from the last rate hike from the Fed to the first rate cut is around 6 to 7 months. So if you take that into account, once we get to the end, roughly 6 to 7 months later, we could potentially see the Fed, turning its shift in stance towards, looking at a dovish pivot. That is what markets are looking for. So if you want to see a 75 basis point in the September FOMC meeting, if there's any strong sell-off, personally, I believe that we could look for some deep buying action, because if that were to happen, we could see markets kind of pulling forward their timeline for rate cut. If we see a more aggressive tightening process over the coming months, and that, could actually bode well for sentiments ahead. So this is just my current point of view in terms of the September FOMC meeting. So of course, nothing comes without risk. Some of the key risks that I'm watching, number one is in terms of valuation. So if you look at different valuation metrics, they will provide you very mixed signal, right? Depending on which valuation metrics that you're looking at. As you can see from this table, some are looking at markets being slightly under the mean. Some are looking at markets above the mean. So it's a very kind of mixed signal that we have here. But if you look towards a more commonly used metric, which is the forward price to earnings ratio, which many people are looking at, that will suggest that the S&P 500 is back to its long-term average at best, as you can see from the orange line. So personally, I will not say that the market is cheap. I will not say that the market is overly expensive as well. And the justification for current valuation, I believe, will really depend a lot on the upcoming corporate earnings season. So we have seen the second quarter earnings, quite a strong beat for market expectations. The main reason is because expectations heading into the second quarter are already low. So it's kind of when the watermark is brought low, there's a higher sort of a high chance of surpassing that kind of a target, right? But if you look towards the third quarter expectations, I would say it hasn't been revised down yet. Third quarter expectations are still relatively elevated. And if you look at the second quarter earnings, if you just remove the energy sector, I believe that we have seen the energy sector having a very strong profit beat in the second quarter. If you just remove that out, okay, from our analysis, the year-on-year decline is actually a year-on-year decline of roughly 4% for the S&P 500 from the year ago. So we are looking at a decline in earnings. So generally, I believe moving into the third quarter, the corporates will have to show that they are able to withstand, they are able to stay resilient amid all this tightening environment. And if you look at the forward price to earnings ratio, generally, I will say the index, the S&P 500 has a hard time staying above the 18 level before the pandemic. Of course, with this ongoing pandemic, the influx of a stimulus from central banks, we are seeing a surge in the valuation. But if you remove that and we look towards a past historical period before the COVID-19 period, I will say the 18 times level tends to be a very difficult hurdle to cross, as you can see from this chart. So moving ahead, in order to justify this current valuation, I think the corporate earnings will play a very key role. So I'll be looking towards the next earnings season where, further tightening will take place. It's really whether the corporate earnings can continue to hold up ahead. So the next risk, I would say, is of course, we have seen the run up in risk assets over the past 1 month. Those run up are kind of pricing for the peak in inflation risk. But now we have seen that being priced in. I think the trade-off for growth should kind of take greater focus over the coming months. So we have to remember that the yield spread between the 10-year and the 2-year treasuries still remains deeply inverted. And looking at past history back in 1989 and also back in 2000, when yield spread are at this level, we see the recession kind of took place around 15 months later. So before we hit a recession, generally growth indicators will start to turn down. Of course, one of the arguments is that markets are still kind of optimistic that the Fed is able to do somewhat of a dovish shift, and that if the current recession is Fed induced, the Fed may have the ability to kind of reverse it by prioritizing growth. So I think this is what some of the market expectations are kind of pricing for. So we have seen that yesterday. Yesterday we have the PMI data out of US. Overall, a horrible figure, I would say. Underperformance in both the manufacturing and services sector. But the initial reaction the markets have is actually a surge to the upside in terms of risk equities assets. So that kind of instill that there are still some expectations that with poor economic readings, that may kind of instill a greater stance for the Fed to turn on this dovish pivot. So definitely the Fed stand definitely play a very key role because markets are expecting them to prioritize growth eventually over inflation, which I don't believe that it could materialize in the near term. But moving ahead towards next year, once inflation risk kind of take a back seat, they could have more confidence in doing this pivot itself. So that is what we could be looking out for. Growth outlook will remain that the cloud of uncertainty moving forward, which I believe may not have been priced to a full extent yet. So over the next few months, next 1 or 2 months, some retests of key support levels are much needed. But overall, I think hopefully we can see that the worst could likely be over for the US equity markets. So last but not least, one of the key thing I'm looking at is consumer spending. We know that consumer spending accounts for more than 2/3 of US economic activities. So looking at the consumer sentiment index, things may tend to improve as long as consumer sentiments hold up. So we have seen the bottoms for the consumer sentiment index kind of largely coinciding with the bottom for the S&P 500. So over the past few months, things are somewhat recovering in this, in this consumer sentiment index after hitting its record low. And that could be account for some of the upside moves that we have seen in the S&P 500 in July and August. So of course, looking ahead, consumer spending will remain the key component, kind of underpinning the economic growth. So we will want to see a continued improvement in ratings. And for now, consumers are dipping into their savings, they're dipping into borrowings to fund their spending. So on that side, there's kind of a mixed signal. I mean, if you want to spend, it's either dip into your savings or you really borrow, right? Of course, if you remove the increase in the real income, as of savings right now, it is below its 10-year historical average. So it's really a question on how much further can they dip into savings. But on the other side, latest figures show that credit growth continues to improve. So it's really a mixed signal there. I mean, consumers are still willing to borrow amid this increasing interest rate environment. They are still dipping into their savings, but savings that side, I believe, could take on a more limited role, considering that it is already below their 10-year historical average. So it really depends on, it's kind of mixed signal there. I think we could really have to see consumer sentiments kind of hold up, consumer spending kind of hold up in order for markets to really continue on this upward bias move. Okay, so with some potential toning down in terms of inflation risk, along with increasing growth risk, of course, some of the key factors that we can look out for will be for the US 10-year yield. So let me just switch my slides over to show you some of the levels that I'm looking at for the US 10-year yield. Okay, so we know that as long as yield stays strong, equities kind of have some headwinds to go higher. So this is the monthly chart for the US 10-year yield. First of all, what I'm looking at is the bearish shooting star candlesticks, as you can see from here. So things are attempting to move down, and then recently there was a very strong recovery. On the weekly chart, what I'm seeing or what I'm hoping to see is, this could be a left shoulder, this could be the head. So what I'm looking out for is whether the US 10-year yield could potentially form somewhat of a right shoulder. Okay, so once we have the right shoulder, if you were to see a break below this neckline, that could suggest a further downside yield for for US 10-year, and that could translate into more risk-on environment, I would say. So things are still uncertain, but what I'm looking out for will be how US 10-year yield actually move ahead. So hopefully we are able to see the formation of somewhat of a right shoulder. So that will be what I'm looking at. Okay, so bringing back to the slides, let me just. Okay, so this is what I've talked about, the US 10-year yield. So if you really were to see somewhat of a breakdown of a potential head and shoulder pattern, what are some of the themes that we could prepare for? One is, of course, if we talk about the moderation in the longer term yields, I think the growth value divide will be put into question. This is considering that the relationship has been playing out to some degree, at least over the past few months. So that may kind of account for the outperformance in the Nasdaq compared to the Dow Jones over the past month, right? Considering that growth tends to be more rate sensitive. So over the past few days, since last Friday, when markets are pricing some pushback from Fed members, the rate sensitive Nasdaq kind of seen a greater downside action as well. And because of the upward interest rate trajectory, if you look at the year-to-date return for Nasdaq, it's still down roughly 18%. The Dow Jones is roughly down 7% year-to-date. So what I'm looking at is that this suggests that more risk may have been priced into growth. So any headwinds, surrounding economic conditions could drive a greater sell-off in value as compared to the growth stocks itself. So that could be one theme to watch over the coming months as economic conditions seems clearly set to moderate further. Okay, the next focus I'm looking at is actually gold prices. If you look at a more measured path of a rate hike from the Fed, generally a decline in US 10-year real yield seems to correlate very, very positively with gold prices. So do take note, this dark blue line is actually the inverse of the US 10-year real yield. So just to show you that inverse relationship here, considering that we know that gold is a non-yielding asset. So if you were to see a declining real yield, that kind of translate to lower opportunity cost for holding a gold, and that could bring some traction to it. Okay, but what may be surprising to me is that since March this year, so we have seen a 10-year real yield seen a very strong surge, but gold prices seems to see a more measured decline. We are seeing a decline, but compared to the scale of surge in the US 10-year real yield, the overall decline seems more measured, as you can see from the blue line versus the red line itself. So, that may lead to gold prices continuing to trade within this period of a consolidation zone. Recently there was a retest of the lower baseline. There was some rebound. Near term, there was some retracement, but what I will be looking out for will be whether it can form a higher lower head, because I think that this actually points to somewhat some resilience in terms of gold prices in reaction to the US 10-year real yield. So if you look at the net long positioning among money managers for gold prices, for gold, it suggests that their net positions are hanging somewhat at its lowest since October 2018. So you can safely say, thus far, gold has not been gaining traction from money managers throughout this whole year. And previously at this level, if I actually draw this red line here, previously at this level back in 2015, back in 2018, it was followed somewhat by a very strong upward move, which reflects a very strong build-up for a gold positioning among all these money asset managers. So with 125 basis point hikes being priced through the year, it's really a question of how hawkish it can really get. And if you were to see somewhat, if that remains as the consensus, I believe that we could be nearing we could potentially be moving towards the later half of the rate hike cycle, and that is where we could see further room of a recovery in terms of gold prices as well. So next up, Japanese yen crosses, that could also be in focus. Looking at with Japan's current yield curve control policy in place, we can see that very, very strong correlation with the US 10-year yield, with a yield differential being the key driver for this currency pair over the past 1 year. So if you were to see an eventual moderation in US yield, I think the declining yield differential could sort of weigh on the dollar-yen pair. And other than that, we know that Japan's inflation rate is at 2.4%, above the central bank's target of 2%. And even though we have seen the central bank trying to push back and say that wage growth is not picking up, inflation is not sustainable, I think over the coming months we will continue to see a Japan inflation rate pulling further ahead of its 2% target. So that could draw in some hawkish bets from members who are seeking to challenge the Bank of Japan yield curve control policy. So we have seen some of those taking action throughout this year. There were several instances where traders try to challenge the Bank of Japan by trying to tackle its yield curve control, trying to tackle its 10-year bond yields. But thus far, the BOJ has managed to push back successfully. They point towards aggressive bond purchases. But I believe that as Japan's inflation moves further above its target of 2%, it may draw more and more traders to challenge its stance. So that may mean more unwinding of a yen short that will very heavily build up over the past 1 year. And we could also draw in some hawkish long bet for the Japanese yen. So that could translate to downside for the dollar yen. If you were also to see the US 10-year yield kind of trending lower with that head and shoulder pattern which I've shown you earlier. So likewise for the euro yen, I think we all know that the economic risk for the eurozone region is very, very high. If you look at the euro yen, it has somehow been trading with a downward bias alongside the fall in the German bond as well. So the narrative is that eurozone is really under great pressure because of their dependence on Russia for energy supplies. So they are under pressure to also tighten too aggressively, even though their inflation are really hitting or even surpassing that double digit. And considering that the recession risk is clearly present there with higher energy prices, plunging economic activities, I think that could limit some of the euro upside. And on the other hand, if you look at Japan, I would say that Japan is more on a mid-cycle recovery in terms of its business cycle as compared to the US, the eurozone, which are towards the late stage of the business cycle. So Japan, I believe, is still at the mid-cycle, recent reopening, trying to lift consumer consumption. So I think the divergence in terms of economic conditions could be somewhat of a downward pressure for the euro yen ahead. Okay, last but not least, if you want to see a very strong pickup in US risk, I think, of course, the US dollar is put into question, right? So let me just show you again some of the levels that I'm really watching for the US dollar. Okay, US dollar, likewise for the monthly chart, another shooting star candlestick that I'm watching here. So markets tried to challenge this shooting star candlestick, try to move lower, but thus far the dollar boost is holding things up. So we are seeing a continued search to kind of overcome this bearish shooting star that we have here. So one of the level that I'm watching at is this 104.4 level. Why? Because if we really went to retest this shooting star candlestick, in the event whereby it fails, okay, things retrace back and then it falls below this 104.4, this kind of confirm this bearish shooting star candlestick that we have here, and that could suggest further downside ahead. So for the US dollar, what I'm watching for is really this 104.4 level. As long as this holds, I think things could still be very, very volatile. Okay, so this is just my point of view. Okay, moving back to the slides. Okay, so having talked about all that, I mean, if what I'm pricing for is if you were to see that US dollar kind of seeing its peak trending lower, that is where it could be a signal to potentially go into Asia markets, because if you were to plot the US dollar against the Asia Pacific index, it tends to go hand in hand. So do take note that this chart, the red line is actually the US dollar index inverse. So this kind of present to you the inverse relationship. So this inverse relationship is more prominent for the Asian markets as compared to the S&P 500 or US indices. Why? Because some of the emerging markets in Asia kind of depend on kind of whole lot of US dollar debt. So if you are able to see the US dollar trending lower, that could point towards some easing a burden on their debt financing. So that could be one of the reasons why the inverse correlation is kind of stronger. So if you were to see that US dollar below that 104.4, I will be looking towards some of the Asia markets as well. I think with their heavier downside as compared to the US indices, that could suggest a greater catch up in terms of the Asia market. Okay, so for Asia, of course, we cannot forget the STI. Recent 3 weeks, there was a sort of an influx of inflows from institutional investors. So you can see since February all the way there has generally been somewhat of an outflow, but recent 3 weeks there was a very strong inflow. Just last week there was around 200 million. This is the net inflow from institutional investors. So whether this really marks the somewhat of accumulation for the STI for Singapore equities, that will be where we'll be watching whether it can form a higher lower head. So institutional versus retail fund flow. The blue line institutional investors, the red line is a retail. So generally there has been a distribution, as you can see, marking from that a widening gap. But in recent weeks, there was somewhat of a near-term convergence. So I think some accumulation could be taking place. Of course, we could have to await a greater signal from there. But as of now, it seems to suggest that some of the institutional investors could be, taking up some long positioning for the STI itself. For sector performance, of course, we cannot forget financial. I mean, the three local banks takes up roughly 45% of the STI. If you look at the yellow line, same thing. A distribution since February until roughly June period, where the sell-off, the outflows, the overall net outflow seems to have taken a breather. It tends to consolidate a little bit, and then recently there was a somewhat of a slight uptick. So what I'm looking at is that if the sell-off really kind of eased and there was some inflows coming back, that will really paint a very good picture for the STI ahead. So definitely want to watch for any formation of a higher low to reinforce this upward bias. Okay, next market I'm looking at is Japan. I think I mentioned previously, Japan, I think is at its mid-cycle economic recovery versus US, UK, Eurozone, which is at its late cycle expansion. Japan indices are largely made out of tech, largely made out of industrial, and I think they are kind of, with their late reopening from the COVID-19, I think their industrial kind of a composition could benefit from this delayed reopening along with a pent-up consumer consumption. So we have seen some of the private spending coming back for Japan. And of course, Japan is an oil importing country with somewhat of an easing in energy prices. That could be tailwind for its firm's margin. And of course, looking at the inflation figures between Japan and the rest of the world, I would say Japan inflation rate are kind of still not as much outside pressure as compared to other developed countries. So I believe that they could still have that room for accommodative policies to remain for its economic growth. Okay, last but not least, this is my last slide. I believe that many may be wondering on how Chinese equities will really turn up. I believe that some form of a patience will be needed. I think there are a lot of headwinds that still need to be tackled. On the valuation side, of course, things are attractive. Okay, so I believe that this could be more for a longer term hold itself. So for the Nasdaq Golden Dragon China Index, what I'm looking at is this strong deep buying on two instances. You can see this bullish hammer being formed. There was an upsurge, but it was relatively short-lived. It went down. So this chart was actually 2 weeks ago. But if we were to update it, we could see further downside. So sellers are seeking to challenge all of these deep buying efforts. So whether they can eventually succeed, I think we will have to watch. But what I'm watching for is this bullish hammer candlestick, because thus far it seems that the selling pressure remains in control. Okay, so if this this bullish hammer didn't manage to do its part, what this means is that there could be further downside. So at least for now, there's some deep buying around this 5,200 level. So this is what I'm watching for. Okay, so with that, I've come to the end of my presentation. So I hope to really share with you some of the key levels that I think should kind of materialize in order to really see a very strong pick-up in risk sentiments. Near-term weakness as seen from the seasonality, and I believe near-term there could still be some pushback looking at the inflation projections. But towards the end of the year, things should turn for the better. So this is just my personal point of view. Okay, so with that, I'll pass on the time to Kwan Hao, who will share with you more on his market insights.
Okay, thank you, Jun Rong. So before I pass it to Kwan Hao, I just wanted to highlight that if you guys have any questions on any of the topics, please feel free to type it in the question box, and we will address them after the second presentation from Kwan Hao. So I see a few questions primarily asking on the recording of this webinar. And yes, so this webinar we will be recording it and uploading it onto the IG Academy as well as on our YouTube channel. So please look out for it in due time. It should be up within the week or so. So next up, we have also invited guest speaker and market veteran Wong Kon to share his views of the market. So if you have been tuning into our webinars, we back in January and in May as well this year, we have also invited him to give a little bit of his views and how he's trading the markets. And I would say it's quite spot on, I would say. The views that he gives has been quite accurate. So we are very happy to have him again here today. So before I pass it to him, I'll just give a very brief introduction on Kon Hao. So Kon Hao has more than 25 years of trading experience in the financial industry. He often also receives a lot of invitation to share on his market knowledge and trading insights with industry practitioners, fund managers, prop traders, and also retail investors. Okay, not only that, right, he also conducts training session for trading representatives as part of their continuous education program, and not only in Singapore, but also in Hong Kong, Malaysia, and Thailand. Okay, so with that, I will pass the time to Kon Hao. Kon Hao, if you are there, you can start to share your screen and your slides.